In June 2015, a junior employee at Deutsche Bank typed one word into the wrong field: gross instead of net. Within seconds, roughly $6 billion vanished from the bank's books and landed in a hedge fund's account. The trade was supposed to be a routine currency settlement worth a few $1,000,000. Instead, one wrong dropdown selection triggered a payment 1,000 times larger than intended. This wasn't a hack, it wasn't fraud, and it wasn't a market crash caused by panic. It was a single misplaced keystroke, and it is far from the only one in modern financial history. Since 2005, a small handful of these so-called fat finger errors have repeatedly frozen trading desks, crashed stock prices, and in at least one case, destroyed an entire company within 45 minutes. The stakes each time are almost absurdly disproportionate. Billions of dollars moving because of a typo, a swapped field, or a decimal point in the wrong place. So how does one small input error cause this much damage, and why does it keep happening despite every safeguard built to prevent it? To understand the Deutsche Bank case, you have to understand the difference between gross and net in a settlement system. In a currency trade, the gross amount is the full value of the transaction before offsetting fees and adjustments. The net amount is what actually needs to change hands after everything is settled. Those two numbers can differ enormously, sometimes by orders of magnitude, depending on the structure of the trade. The employee processing the transaction selected the gross figure instead of the net figure when entering the payment instruction. That single selection sent the full, unnetted value of the trade, all $6 billion of it, out the door. Under the bank's own procedures, an error like this was supposed to be caught by two separate layers of manual review before the payment went out. The payment cleared, and Deutsche Bank was suddenly out $6 billion, sitting in an outside hedge fund's account overnight. The bank only caught the mistake after the fact and had to scramble to recover the funds the next business day. Regulators later scrutinized the bank's internal controls, and the episode became a widely cited case study in operational risk. But Deutsche Bank's $6 billion mistake wasn't even the first time a single input error had rattled a major financial institution. A decade earlier, in December 2005, a trader at Mizuho Securities in Japan made an error that has since become a textbook example in finance courses worldwide. The trader intended to sell one single share of a company called JCOM at 610,000 yen. Instead, the order entered the system as an instruction to sell 610,000 shares, at just 1 yen each. The price and the quantity had been effectively swapped. JCOM didn't even have that many shares in existence. The order vastly exceeded the company's entire outstanding share count. Mizuho tried to cancel the erroneous order almost immediately. The Tokyo Stock Exchange's trading system, however, had a flaw that prevented the cancellation from processing correctly. The order stayed live, and the market reacted exactly as you'd expect to a flood of shares appearing from nowhere at rock-bottom prices. By the time the chaos was contained, Mizuho had lost more than $300 million. An investigation later found that flaws in the exchange's own systems had made the error far worse than it needed to be, and the Tokyo Stock Exchange itself faced criticism and later paid compensation over the incident. A single swapped field, price for quantity, had cascaded into one of the most expensive trading errors Japan had ever seen. 7 years later, a very different kind of error produced an even faster collapse. On August 1st, 2012, Knight Capital Group, a major American market-making firm, rolled out new trading software to its systems. A piece of old, dormant code left over from years earlier was accidentally reactivated during the deployment. That old code began sending a flood of unintended orders into the market the moment trading opened. Within about 45 minutes, Knight Capital Systems had executed millions of erroneous trades across roughly 150 different stocks. Prices on several of those stocks swung wildly as Knight's algorithm kept buying high and selling low, again and again, faster than any human could intervene. By the time engineers managed to shut the system down, Knight Capital had racked up losses of roughly $440 million. Knight Capital survived only because it was rescued through an emergency investment from a group of other financial firms, and it was fully absorbed into a competitor within months. A single botched software deployment had effectively ended a company that had existed for over a decade, in under an hour. The following year, a strikingly similar disaster played out in China, with an extra layer of scandal attached. On August 16, 2013, a software error inside Everbright Securities triggered a wave of unintended buy orders on the Shanghai Stock Exchange. In a matter of seconds, roughly 23 billion yuan, worth several $billion, in erroneous buy orders hit the market. That sudden wall of buying briefly spiked major Chinese stock indices, catching traders across the market completely off guard. What happened next made the Everbright case worse than a simple technical mistake. Rather than immediately disclosing the error to the public, Everbright quietly began hedging its exposure, including short selling, before making any announcement. Regulators in China later determined this amounted to trading on information the public didn't yet have, and pursued the firm and several executives for market manipulation and insider trading. The The company was fined heavily, and some individuals involved faced trading bans and other penalties. What began as a software glitch ended as a full-blown regulatory scandal, precisely because of how the firm chose to respond after the fact. Taken together, these four cases, Deutsche Bank, Mizuho, Knight Capital, and Everbright, show the same basic pattern playing out across different countries, different decades, and different types of errors. Every one of them traces back to something almost embarrassingly small: a wrong field, a swapped number, a stray piece of leftover code. It's worth asking why modern financial markets are so vulnerable to mistakes this small in the first place. The answer largely comes down to speed. Modern trading systems are built to execute orders in milliseconds, far faster than any human reviewer could realistically double-check every transaction in real time. That speed is the entire point of electronic markets. It's what makes them liquid, efficient, and cheap to trade in. But the same architecture that executes a correct trade instantly will execute an incorrect one just as instantly, with no built-in sense that something looks obviously wrong. A human trader glancing at an order to sell 610,000 shares of a company that doesn't have that many shares might pause. A fully automated matching engine generally won't, unless someone specifically programmed it to check for exactly that scenario in advance. Exchanges and firms do build in safeguards, circuit breakers, price bands, and order size limits meant to catch obviously erroneous trades. But these systems are usually calibrated for large, systemic market moves, the kind that signal a genuine crash or panic. A single error that's large enough to cost hundreds of millions of dollars can still be too small or too fast to reliably trip a market-wide circuit breaker. That leaves a dangerous gap. Errors big enough to be catastrophic for the firm involved, but not necessarily big enough to automatically halt the market around them. Human review processes are supposed to fill that gap, but they carry their own failure mode. When a review step almost never catches a real problem because errors are genuinely rare, the people performing that review can drift into treating it as a formality rather than a meaningful check. That's likely part of what happened at Deutsche Bank, where two separate layers of manual review both failed to flag an amount 1,000 times larger than expected. Trading floor culture adds another layer of pressure. Desks operate under constant time pressure, with bonuses and reputations tied to speed and volume, not to the number of transactions someone paused to double-check. Slowing down to verify every entry, every single time, runs directly against the incentives most trading environments actually reward. It means the entire system is optimized for speed first, with error catching treated as a secondary layer bolted on afterward, rather than built into the core design. Regulators have responded to some of these specific incidents directly. After the Knight Capital collapse, the U.S. Securities and Exchange Commission introduced stricter risk control requirements for firms with direct market access, formalized under a rule commonly referred to as the Market Access Rule. That rule requires firms to have pre-trade risk checks in place, specifically designed to catch orders that fall outside reasonable size or price limits before they reach the market. Exchanges in multiple countries tightened circuit breaker thresholds and added additional layers of automated order screening in the years following these incidents. None of these fixes eliminate the underlying risk entirely. They simply narrow the window in which a single bad input can cause unlimited damage. Zooming out, this pattern isn't unique to trading floors, even if trading floors make the consequences most visible and most expensive. Any system that combines extreme speed, real financial or physical stakes, and limited built-in sanity checks is vulnerable to the exact same failure mode. The specific numbers involved just happen to be enormous in finance, because the systems are designed to move enormous amounts of money as efficiently as possible. What makes finance particularly unforgiving is the combination of speed and irreversibility. Once an order executes and a trade settles, unwinding it isn't as simple as hitting undo. It requires cooperation from whoever ended up on the other side of the trade, and sometimes intervention from the exchange or regulators. Deutsche Bank got its $6 billion back specifically because the hedge fund on the other end cooperated. A less cooperative counterparty could have turned an embarrassing internal error into a much longer, much costlier legal dispute. Modern algorithmic and high-frequency trading adds a newer wrinkle to this same old problem. Increasingly, the entity making the split-second decision isn't a human at all, but an automated system reacting to market data faster than any person possibly could. A single bad input into one of these systems, a miscalibrated parameter, a corrupted data feed, an unexpected edge case in the code, can now cascade through thousands of trades before any human even notices something is wrong. Knight Capital's 45-minute collapse is, in some sense, the small-scale preview of what a purely automated version of the same failure could look like at even larger scale. As trading systems become more automated, the theoretical ceiling on how much damage a single bad input can cause in a short window of time keeps rising, not falling. For most people outside the financial industry, none of these specific incidents change daily life in any visible way. But the pattern underneath them says something broader about how fragile even the most sophisticated systems can be at their weakest, smallest point. enormous, carefully engineered financial infrastructure built by extremely well-paid, highly trained professionals has repeatedly been brought to its knees by something as mundane as a wrong drop-down selection or a piece of forgotten code. The most catastrophic failures didn't come from some brilliant, complex attack that outsmarted every defense. They came from a single, ordinary human decision, made in a fraction of a second, by someone just doing their job like they had 1,000 times before. That's precisely why these cases keep getting taught in business schools and risk management courses years, sometimes decades after they happened. They're stories about what happens when speed and scale outpace the very human systems built to keep them in check. Every safeguard added after one of these incidents narrows the odds slightly, but it never removes the underlying tension between moving fast and moving safely. As long as financial systems keep pushing toward faster execution, larger volumes, and more automation, that tension isn't going away. It's simply waiting for the next wrong field, the next swapped number, the next moment when a system built for speed has no way of knowing that something has gone catastrophically wrong. $6 billion, $440 million, $300 million. These numbers all started the exact same way, with a single, ordinary keystroke that nobody thought twice about at the time.